be a successful investor rather than holding on to the share, think that one day it will come back. It will never come back. The shares are such that it will never. What we have seen in the small cap companies in September, 800 rupees, 1000 rupees, just come back to 300 rupees today. You think it will go back to 800 rupees in a hurry? It will not happen at all. So we must understand the ground reality and cut it off completely. There are innumerable instances where I have seen company shares going up and, whether it is due to manipulation or whether it is due to promoters buying or whatever you can call it, but the shares are giving phenomenal growth in some of the sectors and companies. But one thing I can tell you, you must be a contrarian. What Babu was asking me, if things are very bad for an industry, maybe that's the right time to look at that share. I still remember in one of our meetings, Ashok Leyland was quoting around 27 rupees. I'm talking of 15, 20 years ago, a 10 rupee share, 2000 or 99. So when we were discussing, we used to say some of the companies and all that. So when we were saying, why not buy this local company, good company, automobile will always have a good growth story. Then one man got up and said, no sir, they are working only 3 days a week. So that company doesn't have orders. They don't have any future. It is not the way to look at it. Because it is working 3 days, because there is no demand, the share is quoting at 27. If the company was working 6 days, the share price would have become 150 or 200 rupees. That's how you must look at it. So you must apply your mind and look at those kind of shares and then grow along with that. Same thing holds good for Godrej Consumer. I still remember we were discussing in our meetings at 27, 26 rupees. People are reluctant. They said FMCG is gone case. It will never be a gone case. A good promoter with a good product will never go anywhere. Please look at that more often than anything else. This is what I can say, Babu.
Thank you, AKN. And some life lessons from your equity adventure relating to this book, if you can relate to, and that'll be great.
Absolutely.
Thank you.
I will actually take off, Babu, from where you brought in the Roger Federer example, that he told he lost 52% of the points and still won. I mean, the question is, how did he win? The point is, he won the points that mattered, and the points that didn't matter, you can lose. And I think in investing also, why did these investors make money is that when they won big. So that you can have a lot of small losses, but that one big win will compensate. So I think that's where it goes back to saying that, you first need to have patience. And then when you win, you have to win big. It's the same Roger Federer example. And then again saying that, what type of an investor I am. I would say I'm a connoisseur, but by accident. Okay. I don't think I, learned and became a connoisseur. If I had to go back, my investing experience, probably started in 91. When whatever I had invested went down to zero because of Harshad Mehta's scam. Okay. And that was probably a very good learning experience, because then you realize that, this can, scotch you, you can get burnt, and after that, typically, nothing happened to the market. I think for 5-6 years, the market, nothing happened, and then at that point in time, again, being a good mutual fund man now, even at that point in time, I think it was already ingrained in me that I really didn't get into stocks, because again, getting into stocks is very difficult. Okay. There are two parts to it. One is first making all the analysis, you have the time making the analysis and then making the buy. And the second one is actually executing it. As Lee Freeman Shore is saying, if buying is easy, executing it is even harder. It's like, if you think making money is easy, preserving it is harder. So at that point in time, I think I pretty much moved on, away from getting into these individual stock shares where you never know what sort of, rigging is going on, what sort of information is there, information asymmetry. And so I've been, for a long time a mutual fund investor. Luckily or unluckily at that point in time, I was not here and I was saying, I was overseas. And that funds just went and luckily there was no Grow and Paytm for you to look at it every day. So you probably looked at it once in 3 months or 6 months, and since it kept growing. And then after about 5-6 years, you realize that the best thing I did was I did not look at it, did not do anything. No action was the best. And then I realized that probably this is the only way to make money, having lost money, trying to do some stock trading. So I think that is how I became a connoisseur, completely by accident, it was not thought out. And I think that has stood well, over the course of the next, 15, 20 years. And I think in a country like India, it is very easy actually to be a connoisseur. I don't think there is a necessity to try and be any other. Because if you think that this is a growing economy and if the economy is growing by 6.5%, nominal GDP. Sorry if I slip into my usual marketing sphere here. Then your, real GDP and nominal GDP is growing at 12, 13. Any company should grow at 1.5 times there. So making a 14, 15% return is pretty much a slam dunk if you're there over the long term, and even if it is a very diversified portfolio. In fact, I completely disagree with Lee, Shore when he says that mutual fund managers, are doomed to fail. I don't think so. It probably might be the case in a developed economy, but I don't think that is really the case in a country like India, where you can really get a 12 to 15% return as long as you're patient and you're invested over a longer period of time. So I think, that is the, in terms of what I've become, I'd say is that, a connoisseur by accident. And also, if you had to look back, it is very difficult to be an assassin or a hunter. Okay, that is what Lee, he says he's talked about 5, I think, 5, and 2 of them are assassins and hunter. An assassin is someone who ruthlessly cuts his position when the stock falls 20%. Okay, and how many times can you do that? And he's saying he's also saying you'll have to take a big position size. There is no point in having, as Babu was saying, 2 lakhs invested over 50 companies. You need to take, big chunks. And of that one big chunk, 20% is gone, and then you cut it. I mean, it requires phenomenal amount of courage and, behavior. And I don't think many people have it. I think there are very, very few people have it. And I think one of the things that, as an investor is to know your trade and be comfortable in your skin, not try to be something which is very difficult, because I don't think a rabbit can become an assassin. It's impossible. A rabbit is someone who really doesn't do anything. He puts it and then hopes and prays it goes up. If it goes up, fine. If it falls down, tough luck, he's trapped. And the other one is also equally difficult, is a hunter. So the hunter is someone who's a drop 20%, he will buy more. Okay. While yes, in hindsight, as you said, it was down 40%, you can buy, but at that point in time, you put in substantial chunk of your money, it is down 20%. Again, to buy becomes difficult. And again, all stocks which fall don't go up. In fact, again, he gives a wonderful example. He says that almost 60% of the stocks which fell below 20% did not go back up. Only 30% went up, which means other 70% never went up and saw the heights. And the important question to ask then is that he says that, will you do now, knowing what you know now, what you did earlier? So which means if you had earlier bought it at, 100 rupees, now the stock is at 75 rupees. Now knowing what it is, will you buy it? Very difficult. It is easy to put it in paper, but now you're so, muddled, 35% is lost. You can't take those decisions. That is why, I think it is better in the hands of a diversified professional manager than trying to, be a hunter or try to being an assassin. The other one, which is what he calls the raiders, which I think most people are. I think most of the Grow and Paytm investors are raiders. You go, it is up 2% today, you exit and you come out. But in the end, you will never make much money. Because over the period of the law of averages, you make 5, you will lose 7, and net, it is brokerage is all you paid, and the only winner is the brokerage house. No one else has gotten anything. So I think with giving all this, I would think that, it is actually easy to be a connoisseur. It is not difficult to be a connoisseur. All you need to do, as A.K. Narayanan sir was saying, was that be patient, trust in the overall progress of the economy, and obviously if the economy is growing, the stocks will grow, and sit back and relax. So I think that would be my, submission.
Thank you, Loganathan. That's a ton of insights. Thankfully, we have a video recording which we can go back and kind of refer to. With that, I'm going to get to a little bit controversial, but a quick round. Is that in our life journey, and I mentioned it earlier, that we have 20 years of individual experience in stocks. I'm sure we've all made mistakes. I want each of us, if we can kind of talk about one thing which you can turn the clock and undo a mistake that we did in our past, so that becomes a reference point. And I want to start with myself, right? Like Loganathan said, today I truly believe a mutual fund negates a lot of individual stock picking problems. But back in the days, I did make a lot of mistakes. I still do. Only thing that I'm able to relate to some of those mistakes. In the good old days, there was this Times Bank there was a bank called Times Bank. I don't know how many of you all are aware. The Times of India used to run a bank at one point in time. They came out with an IPO as well. I was one of those lucky guys to get allotted 1,000 shares. And for a year or two, the share price didn't move much. It was right there until HDFC Bank came along and acquired Times Bank on some swap ratio. I got a bunch of HDFC shares for my 1,000 shares of Times Bank. And the moment it got converted to HDFC, the price moved up just a bit. Right? I must have seen about 15% profit for 3 years put together of that investment. I rushed to my broker. In those days, there was no online, there was physicals. So I rushed to my broker and I said, please sell. It's 15% up for 3 years, which is actually 5% a year for my 3-year investment. And I sold it all. And I must have had 400 or 500 shares. I don't remember the number. I was doing a calculation about 2 years ago when I had some free time and I wanted to regret a lot of my things. I discovered that if I had held on those 400 shares of HDFC, 10 rupee shares of HDFC at that point in time, it would have been worth about 12-14 lakhs of rupees or thereabouts now, or 2 years back. And I don't even remember what I did with the money. I sold those shares and they came into my bank and I don't know where they disappeared. Right? And exactly the point he talks about, like he mentioned about the hunters. So he says, don't look at these tiny profits in stocks. Don't look at a 10% upside, 5% upside. If you're in stocks, like, in cricket, they always say, if you step out of your crease to hit the ball, you're taking a big risk. You could be stumped, you could get run out, so many things can happen, right? So the payoff for that should be that you should try for a 6. If you step out of your crease to hit a ball and you take one run, it is not an even payoff. Similarly, in stocks, if you're getting into a stock, then go all in and look at a big multiple. I did that mistake and I didn't do enough homework. I didn't have enough conviction then. I'm talking about 20 years ago. I am much more wiser now. Not that I do so much of stocks now, but I believe that you will need to give time for any of these investments to mature. So that's my learning, where every now and then when I want to feel regret, I just open this calculation and look at it. Yeah, I should have had 14, 15 lakhs of worth of portfolio now, which I don't. So over to you, sir.
A lot of regrets are there for a person who has been investing for so long, and nobody can deny that, because so many companies came in between, and 84. Yeah. But like what you said, in 2000, when the Ketan Parekh scam broke out, I had sold some shares, and when I met the broker for some money, it was about, if I remember right, it was some 40,000 rupees or something. He said, sorry sir, I don't have the cash, but I can give you some shares instead of that, he said. So I said, instead of cash, you will give me shares. So he also told me that Ketan Parekh scam has broken out now. So you have to take the share, and tomorrow morning I am closing the office. So I said, what to do with that? So I said, what share you are giving? He said, I'll give you 1,000 shares of Eicher Motor. So Eicher Motor is a good company, I heard about it. So I said, then I also bought some shipping corporation, he said he has got. So I bought those 2 shares, he gave me that for the amount he has to pay me. So it's about 40,000 rupees or 35,000. It is 15,000 plus about 18,000. But he told me one thing before I left. Eicher Motor, sir, don't sell it. He said, you are closing the office and you are giving me advice. I said, forget it. So I went away. Then I didn't do anything with these 2 shares because Shipping Corporation gave me a dividend of huge dividend, 18 rupees per share or something like that. I got some very huge dividend next year, some 18,000 or something for this 1,000 shares. So I thought this share has become free. Let it be there. Why to talk about this? So Eicher Motor, I was just keeping quiet. Then the Eicher Motor, suddenly I saw it moved 100 rupees from 10 rupees. I said 10x it has come, so what to do now? So I didn't do anything. So I can't talk to this man because he closed and went away. So I was just watching and then talking to a few people. They said it's a good company. It may revive. So it went on to touch 1,000 rupees. So 100 times. So I said we have made money. So why not we sell 100 shares? So I started selling 100 shares, 200 shares like that till 2,500 rupees. But can you believe, Babu? The share hit 35,000. What can you say now? 35,000 rupees, 3.5 crores. The worst part is that Shipping Corporation is still with me. Because it is free. So what more regret one person can have than this? But then, as you said, 20 times you have made money, so no problem about that. The other one was, one gentleman came and told me, sir, you have to buy one company called J Corp at that time. It was quoting 5 rupees. I said, this company is going to, absolutely good for nothing share. I don't want to buy it. He said, don't sir, you must buy. From nowhere he came and said, you buy it, and I bought 1,000 shares of that. So I bought that and ultimately it went on to become 100. I said 20 times it has grown and let me sell it. Then he came and told me, Narayan, you must buy some more. I said 20 times it has grown, again you want me to buy? I said, I'll keep quiet. It went on to 500 rupees. Then also he came and told me, please buy it. I said, I will not buy this. I'm going to start selling, I said. From 750, I thought I'll start selling under 100. At 1,500, I got out of the 1,000 shares. Can you believe what rate it went? It went to 21,000 rupees. So what a regret. I don't know whether it's a regret or loss of profit or what to say.
Thank you, sir. Look, finally, quickly to you, what is that one regret you have? Go for the questions now.
Done. There are a lot of regrets. I have I can recite the regrets throughout the evening. But I'll tell you, the latest regret I would have is that the post-COVID rally, I didn't see it. All right. In hindsight, if we had seen that, I would have really, we got to put a lot more money in mutual funds. I would definitely not gone into stocks. So I think that is a, regret, because after so many years, you can still make mistakes. You think that you've been in the investment area, that you are reasonably aware of what is happening. But then again, that's what emotions take over, because post-COVID to really go in and invest, required a little more courage than what was normal. So I think my biggest regret is that, after all these years, you still make mistakes.
Thank you, Lognathan. Well said. We are never masters of our emotions. We continue to kind of be, controlled by emotions irrespective of years of experience. So that's a great learning. But so we have a bunch of questions. I also want to ask the audience here, those who have come in person, to keep your question ready. But I'm going to read the question which is here. To Mr. Narayan, this is your question. What kind of mindset do you recommend for Indian investors to develop resilience and execute their strategies? Rahul from Salem wants to know.
It's a good question from Rahul Salem. See, I feel that, like I said in the opening remark, if you are looking at a long term and if you are having patience, you are going to be win. But only thing is, you have to back the right horse. If you go to buy a company like Kingfisher or NEPC Agro, you're going to be the loser. So look at good companies and buy a share, maybe a 2-3 lots, don't buy in one shot. But your mindset should be to look at long haul and don't look at short term. It is not T20 cricket. It is a test match scenario. So you have to wait and then watch and then things to grow. And you are not making any mistake by investing in an equity market. So practical advice will be to buy small quantity of shares at different levels over a period of next 6 months and then create a portfolio so that you will not make any big mistake.
Thank you, sir. Thank you. Very valuable. Lognathan, I'm going to put the next question to you. Many investors struggle with knowing when to cut their losses and hold on to a position. What practical advice do you have for investors making these tough decisions? Yes. From Daniel.
Yeah,
Bangalore.
Thanks. I think it's a very pertinent question. I'll give 2 answers to it. My first answer is don't invest in stocks. Okay, invest, in mutual funds. I'm not saying because I'm from the mutual fund, because it is very difficult, to invest in stocks and make money, unless it is your day job, you're not going to make money unless, you have developed a lot of expertise and have learned to control your emotions. If you still want to, do that, what I would say is that, I think follow what is there in the book. Have a predetermined stop loss. You gotten into a stock, you think you've done your research well, but still the stock is down, once it's down, let's say 20%, and the author says 20 to 25% is ideal, where you have to take a decision either to sell or whether to buy more. Okay, so if it's down 20%, and based on what you know now, will you buy it or not is the question you should ask. And if the answer to that is no, then sell it. And if the answer to that is yes, then buy more. Okay. But having said that, it is very difficult to execute it in practice because, we are not trained professionals to have that heart. And even the trained professionals really do it because it is other people's money. It's so much more, it's natural. It's so much, it's because emotion goes away. You can take a decision. It's not that they are mishandling your money. They can take a decision which is not driven by emotion. That is the difference. Why do people take wrong decisions? Is essentially because emotions muddle with your rationality. And when you're investing in a stock individually, that muddle will be always there, unless you're extremely, good and are able to bifurcate it. And that's why you go to a professional fund manager, because to him, it is demarcated. He can look at it very objectively. That's my.
Thank you. Thank you, Loganathan. Sir, we need quick answers. Now, 30-second answers. What's your point of view, sir, on compounding? Do we need to stay invested for longer from Sanjana?
If you want to achieve power of compounding, definitely you have to stay invested. I'll tell you a simple example. Somebody invested from 1st July 2002 till today. They have compounded at 18% rate of return. And, 5
Is
lakhs.
that some person, A.K. Narayanan?
5 lakhs of rupees is today 6 crores. Same thing, I'll tell you one more analogy. People think gold was 500 rupees a gram at the same time, 1st July 2002. Today it is 90,000. So automatically, you would have made 90 lakhs. So where is 90 lakhs? Where is 6 crores? Which is better asset class? You can decide.
Okay. What specific 3 shares or stocks can we? That I will pass, my friend. I am not going to. We are not going to be drawn here. Pass on all our behalf. Thank you so much. This is not a tip giving. We want you to read the book. Yeah. So the best investors go wrong but still make millions by executing strategies wisely.
To answer the second part of that question, or which 3 mutual funds, again, I would say, don't invest in a mutual fund, the names, there are 40 out there. I think invest in a cap curve, invest in a large cap fund, invest in a diversified fund, invest in a mid and small cap. If these 3 are there, by and large, your investment is done. There is no better expert than A.K. Narayanan sir, to say that. So I would.
Well done. Thank you. So the best investors go wrong but still make millions by executing strategies wisely. How can mutual fund investors ensure they are aligned with fund managers who execute effectively? This is to Loganathan.
Yes. Yeah.
The mutual fund question.
See, the way is to look at a mutual fund house. What is its track record? How long has it been there? Look at how some of its funds have performed over a period of time. Do not look at a short-term performance. Do not look at the last 2 years, last 3 years, So see, and also look at the management, the quality of the fund managers. And I think once you're able to have a track record, then I think the decision becomes much easier. So I think that's all I would say, and typically all mutual fund houses always, professionally manage the company, manage the funds. And it is not to say that you cannot invest in a new mutual fund which has come. That is not the case. You can't wait for a 20-year track record, before you invest in a new mutual fund. Look at the track record. Look at the fund managers who are there. Look at what has been the previous experience. And once that is established, I think, you should be able to go ahead and invest.
Thank you. Thank you, Loganathan. The next question was a very interesting question. There was one more question I saw. What is safer, mutual fund or FD was the question I saw. I have a very important comparison I make. I normally say the ship is safest in the harbor, but that's not what it's made for, right? So your money is safest in FD, but I'm not sure it will serve your long-term needs if all your money is in bank or in fixed deposits. So certain amount of your money should take risks. And the mitigation of that risk happens if you invest in the right product and stay invested, like A.K. Narayan said, over a long period of time. So is there a, next question, is there a correlation between performance of a company and the share values of the company? Yeah.
See, there is definitely a correlation. The share price doesn't go up just like that. The revenue has to go up, profit has to go up. These two are the important parameters. That is why people say the earnings are very important. If you are buying a good company where earnings are good, automatically the share value will automatically reflect in the company's performance and the shares. If the company is making consistent losses, the share price cannot go up unless something happens elsewhere.
Unless it's Swiggy or Zomato.
Correct. So don't do that. So definitely there is a correlation between performance of the company and the share value.
Narayan, you're getting a lot of questions to Mr. Narayan. Even the best investors make mistakes. Of course, the reason he is best is because he has made mistakes. From your experience, how should retail investors handle losses and learn from them instead of being discouraged? From Ravi, Chennai.
There is no question of getting discouraged here. Lot of retail investors are sucked into the system, like what Babu said in the initial period. Lot of people think that they can get into direct mode of shares. Please, like Loganathan said, the initial phase of your investment should start with mutual fund. Thereupon, you can graduate yourself into shares with your experience and expertise. Don't get into that. You are not going to college directly. You are going through the school, then you are going to college. Same way, the going to the equity market is like going step by step. But now, even beyond the college, people are going to futures and option directly, like what Babu was saying. That is why people are losing money. So definitely don't have to feel bad about this. Study well, attend programs of this type. Your awareness and investor education helps you to grow better and better. I must thank all of you for coming on an evening like this and patiently listening to us, and it makes lot of difference to us. That is what, when I said Tamil Nadu Investor Association, when we started in 1990, we never thought 35 years people will support us and continue to work with the association. And if you are not a member, I would urge upon each one of you to become a member of that association, and you will continue to learn from that association very much.
Thank you. Thank you for promoting Tamil Nadu Investor Association. As an initial investor, what are the three major points of your wisdom from your experience?
So I will assume that you're asking as a stock investor.
As
an initial investor. Okay. If you are going to invest in stocks, I would say that, first know your type. Are you someone who can take a loss, or are you someone who can, have a sleepless night if the market is down 2%, 3%. I think that is very important. And once you know what type you are, I would say stick to that. Don't try to change it and modify your investments towards that. I'll give you my own personal example. After all these years, I'm still a very conservative investor. Even in mutual funds, I put in small lots of money. Because that is who I am. And once you're comfortable with who you are, then you sleep easy at night. You're not trying to be someone else who you're not. And I think that is very important as an investor to know who you are and follow that. And I think that will take you almost halfway through success. The second one I would say is that never ever do F&Os or never ever leverage. The moment you leverage, you are really letting yourself, to be bankrupted. So I would say that would be the second most, I think that they wanted 3 points, correct? I think these two are good enough.
Repeat the second one again, third. Yeah. Don't lose money. So like Warren Buffett has the famous thing, right? Rule number 1 is don't lose money, and rule number 2 is don't forget rule number 1, right? So similarly, we can use this. So last question I'm going to quickly take. Which asset class should we choose? Equity, gold for long term, 5+ years. Dot say 60% equity, 20% debt, 20% gold, equity, gold. My friend, the essence of this talk is, I think, as AKN said, is that the best way to prosper in the future is that none of us know what the future holds. Equity, gold, debt, and real estate, in whatever formation that you think is good, is how you should approach it, how comfortable you are. There is no one asset class where you should put all your money, and that's a bad idea. So keep your investments in all buckets. Some bucket you can have more because if you're a real estate person, you can have a little bit more in real estate because you like that asset class, you understand that asset class. If you're an equity person, have a little bit more in equity. But make sure that you diversify your portfolio, and that's how I would kind of say. We're completely run out of time. I wish we could talk longer. All three of us are passionate, but there is a program and we are well past the time. So thank you so much to both my panelists for being here and all of you all for being here and asking such lovely questions. Over to Group Captain Vijay.